Shall I just introduce myself?
Yes, please.
All right, why not?
This is a different
Informal.
workout.
Good, because you guys have almost hit my, first of all, I have a colleague out here, Nisha. Don't hold anything I say against her. She's wonderful. I've been starting talks lately by saying I increasingly realize that I've gotten old and grumpy the longer I'm in this field. And having been at Heron, I'm the president of Heron currently for 15 years, there's some basis for that grumpiness. And so you guys have almost hit my trifecta of things that really elevate my blood pressure this morning between, oh good, she's nodding, thank you for that. Between attribution, additionality, and if only you had invoked intentionality, we would have had the trifecta. So backing up, I'm Dana, I'm with the Heron Foundation. To be clear, because I have no idea what the makeup of the room is, we are a private foundation. So we are both philanthropist and investor. And at Heron, for really, frankly, 25 years, we have not had, do not have, a program side and an investment side. Almost since our founding, our trustees were horrified to learn what the private foundation model is. When they realized that we're anonymous by founding, but if you know anything about private foundations, somebody somewhere, you going to stay or are you going to go?
I just figured out.
Okay.
I crashed your party.
I'm good with that.
I'm not even next, though. So.
It won't stop me. I'll keep going. Somebody somewhere takes a tax deduction to create a private foundation. And the presumption is in exchange for that deduction, the assets will be working in service to society. However, many of you probably also know that really, actually, it was intended to be a floor, but it has de facto become the ceiling. Private foundations only are required to spend 5% per year on doing good. And so the way the investment model has developed over the years, you have an engine, 95% of the assets making money with money, and 5% of that is peeled off to do some good. And so for us, in 1996, our then board chairman, our board comes together twice a year from around the world, frankly, and they would spend 2/3 of their time together discussing the returns on the investment portfolio. And that's not why any of them agreed to be trustees at our foundation. And so in 1996, our chairman had a table-pounding moment, and he called what is a seminal question in Heron's history: shouldn't we be more than a private investment company that uses excess cash flow for good? And our board did what boards do. I say this in front of them, so I say it about them. They said, absolutely, we should be, and then they got on planes and went home. And so for the last 20 years, we as staff have been trying to figure out what that means. By about 2012, we had gotten to 50% of our endowment invested in accordance with our mission. Happy to talk about that. A lot of it was program-related investment, concessionary capital. To be clear, based on this conversation about risk and impact and return, I agree with everything that was said. For us, we talk about uncompensated risk. If we are taking uncompensated risk, we use program-related investment or a charitable tool. If we think there's the potential to be fully compensated, it's an endowment investment. So part of our learning was that, I'm happy to say, but wait for the second shoe to drop, we got to 100% invested for impact in December 2016. Along that journey, we learned that there is a world of difference between being invested for impact that we could live with and invested for mission. We're a poverty-fighting organization. To say that 100% of our investments, I can draw a through line between it and alleviating poverty is just false. But to say we know what's knowable, key point, data's terrible. You rely on disclosure, which is problematic. But insofar as we could know what's knowable, we are 100% invested for impact. And just with financial return, as with impact, positions move away from you. They do all the time. So we spend our days optimizing the portfolio to make sure it's invested for mission. So over 25 years, our aggregate CAGR just lags 3%. And everybody's like, so what? Well, I'm so what too. But here's the thing. As a private foundation, you don't have revenue. So that CAGR is net of our operating expenses, which run about 2%, and they're net of our charitable distribution, which as a minimum is 5%. So 3% CAGR over 25 years, which functionally means we've doubled our assets. I'm good with that. especially when we can be honest about the impact we think we're having. I have no idea what y'all want me to do, but one quick story on the path to being invested for mission. This point, I've been thinking a lot about this lately. With Edgar Villanueva's book out there about decolonizing wealth, with discussion of privilege becoming more common, with all of us finally realizing that racial equity will never be a priority if it's only a priority to people of racial and diverse backgrounds. As these things come up increasingly often, I get really annoyed with this notion of attribution, because for me, sitting next to a giant pile of money, which is what I do, it is the pinnacle of privilege to say that investments have to somehow reflect me. Really? Like, can't we do better than that as a society? So, back to my point. There came a time in Heron's trajectory when we had been adding program-related investment positions pretty happily. Many of you know what that looks like. You go out in the market, you're hunting for impact investments. For us, by the way, we underwrite an investment. The last question we call is what we think the rate of return will be, and then we decide to book it as charitable or market rate. We don't chase them and force them into those buckets. It's the last question we call. But so we've been doing that for years, and quite productively, I think. But when the gauntlet got thrown that we were going to accelerate, one of the things we realized very quickly was that we have an incumbent portfolio. It's not like we're starting with cash. We have 2 decades of, quote, conventional investments. And so instead of going out finding new things to do the additional 50%, maybe we ought to really examine what we have. So we hauled Bloomberg terminals into the office, paid a bunch of consultants, trained up our staff PS on how to use the Bloomberg machines, and we jumped into, not kidding, different discussion, 4,000 existing positions to say, we own these. What's knowable about their impact? It's messy, and so we decided, okay, we're philanthropy. What do we want? And at that point in time, we wanted jobs. Remember poverty, right? So we had this broad, and I'm doing this quickly, so there was more thought into this. We said, look, if we can invest in companies that add jobs to the economy, not as an inefficiency measure, but as a measure of their growth, that would be a good way to help people get out of poverty. Jobs, poverty, okay. So we decided we were looking for high head count per dollar of revenue, that if we could just get that and get jobs, that maybe we could claim we were helping improve things for people, place, and planet. Jumped into the portfolio, tortured it. Everybody, whether it was staff or consultants we paid, came up with the same answer. Based on what we owned currently, keep in mind we were examining not just our impact, quote, portfolio, but our conventional portfolio, we should own private prisons. Not a great day for the Heron Foundation. And in particular, it was CCA, Correction Corporations of America, who has since changed their name to CoreLogic or CoreCivic, yeah, which I guess sounds nicer. They're still private prisons. For those of you who are into engagement strategies, we should have a sidebar conversation about how that whole thing went down, because it was fascinating. How can going after exactly what we want as an impact metric tell us that we should own private prisons? Like, that's not okay. So at Heron, many things happened, but not the least of which was we said, you know what, we're not smart enough. I think it's a Gandhi quote about be careful to be not too sure of your own knowledge. So we backed up and said, you know what, we can't, we're not in the business of picking winners. We can't pick a single metric or a single sector and say that's going to help. So we ended up really backing up and saying, look, operating enterprises consume things from society, and they emit things into society. They consume labor, they consume water, they consume property taxes. They emit wages, they emit taxes ideally, they emit lots of things. How do we think about the impact in total of an enterprise? And we're data nerds at Heron. We kind of treat data like a big warm fuzzy blanket, and so we were very comfortable swimming in data. We found ourselves coming to each other saying, oh, they're great on the environment, but they're terrible on labor, but they're great on, and we would say, make a judgment call on net, like literally aggressively handling each other on net. Do you want to own this or do you not? Through the lens of, is this company a net contributor to society's wherewithal or a net detractor from society's wherewithal? That's really what we started to get at. So over time, what we operate with now is a framework we call net contribution. We think it's too arrogant for us, just speaking for our experience, to say We want that thing. We're only interested in the environment, or we're only interested in people, or we're only interested. So we hold ourselves to the standard of knowing insofar as it's knowable. Huge disclaimer, can drive a truck through it. But insofar as it's knowable, what is the net effect of an enterprise on society across all pillars? For us, that's human, natural, civic, financial, and systems. Capital. Each capital is underlined by indicators. What do you care about in human, natural, civic, financial, and systemic? And each indicator is underlined by metrics, things you can measure. We don't allow ourselves to overlay poverty until we've first sat with what is the total effect of this enterprise. If the total effect on net is acceptable, then we look at what is the effect on human and civic, which happens to be our tilt, if you will, because of our poverty focus. We have other complicated examples, which is probably unpopular in this room, but since Astad started the day with kind of let's just go there. In fixed income, we had a situation, not with Breckenridge, where one of our managers, where the manager purchased a pool of PACE residential loans, property assessed clean energy, right? Sounds like a good thing. And they brought it to us and they said, we sourced, because it's kind of a thing with some of our managers that we actually source more than they do, impact investments. So guess what? Problem. And please be clear, we're talking about PACE residential, not PACE commercial. For those of you who know, PACE, I see some heads nodding. PACE loans are not income underwritten. They're often sold by contractors in people's living rooms. And the explanation is usually blah, blah, government program, don't worry. So what the experience was in San Bernardino County was that this PACE lien becomes the senior most lien on that homeowner's capital stack, senior even to their mortgage, who's not required to be noticed, PS, which as a mortgage holder makes me really grumpy because I own pools of mortgage-backed securities. But in San Bernardino, that senior mortgage, or that senior loan is paid back through property taxes. Well, low-income Americans, much less middle-income Americans, can't stroke a significant increase in their property tax. So when that property tax bill comes due, they cannot pay it. It's the senior most lien. It cascades the entire, it's not collateralized or anything. So it cascades the entire thing into foreclosure. So good for the environment. I'm not saying it's not. Lowers the carbon footprint of a household. In theory, lowers the carry of the costs of that energy in that home. All good things. Cascading low-income homeowners en masse into foreclosure, not a good thing. On net, we ordered the divestment of that pool of loans. So that's sort of how we view the world. Super unpopular with our colleagues who had plowed millions of dollars into supporting the PACE program because they did it through the lens of environmental programs. Huge problem in our space. So at Heron, we are wildly imperfect. It will always be our life's work to optimize the portfolio for mission every day. We're dealing right now with a note on some affordable housing in Kansas City. It's a great piece of paper. It's a really well-performing building. Google reviews say the tenants hate it there. Not great. So as philanthropists, what do we do about that? How do we jump in and remediate the tenant experience? And lastly, I guess I would just say, as you can see from some of these, although we can give you additional information if it's useful, people ask me all the time, if you want us to do what you say you want us to do, aren't you presupposing a give up? And number one, that's not been our experience. Our fixed income has outperformed Barclays Ag, 16 years old. Our public equity strategy, which is proprietary, although we have others as well, is top decile. So we're pretty happy. And it really bothers me. I'm constantly asking people to switch the question in a lot of ways. But if what I'm doing implies a give up to you, then is it fair to assume that your, quote, overinflated returns are artificially inflated because you're offloading your externalities onto society? I think it's a fair question. So that's kind of the way we view the world at Heron, both as philanthropist and impact investor, and I have no idea where you'd like me to go.
That was exactly where I was.
Okay. And I'll tell you anything, so feel free to ask. Sorry. Okay, I'll come to you, I promise, Tim.
Yes, I have a question about when you do your research and find out these unexpected pieces of your investments, do you ever go back to your managers and use some activism to perhaps shift that thinking?
So, manager, what would you say to that? What's your relationship with Heron been like?
It's been, I think we're on a journey together.
Yes, is the answer, absolutely, and feel free
Yeah,
to.
we have a very open dialogue with Heron especially. And all of our analysts have had the opportunity to speak with you and work with you, and we've learned from you,
Thank you.
and vice versa. And the Breckenridge, just as background, is one of the fixed income managers, and a big part of our business is public finance, municipal bonds, and most of which, about 85 to 90% of the market, obviously, is tax-free, so it doesn't work for foundations. But you guys like the impact story. And in fact,
Yeah.
if I had asked a question during the first session, I would have said the future of impact investing has actually already been written by the U.S. municipal finance market. It addresses all of the questions that
Totally
you go
agree.
through. And,
Taxable muni
right?
debt
And one of the
specific.
key things that I think we've taught you is one of the first steps in a credit analyst. Sorry, I'm going.
No, you're fine.
Can I sit
Yeah.
there?
Come on up, Tim.
One of the first steps in a credit analyst in looking at municipal finance is essentiality. How essential is the public purpose? Which is it's how the market has addressed the notion of impact. And the premise being that if you're lending money to a community, they're more apt to stand behind a school, K through 12 education, than they are a parking garage or a golf course or something like that.
Yep.
Anyway, I
And
could
just-
go on and on. I didn't.
No,
Did I
but
answer
just
your question?
since this room seems to be generative and interested in tackling real issues, one of the things Heron's struggling with now, fixed income, I love me fixed income, I love muni debt, particularly the little bitty shred that's taxable muni debt. But that said, I think we, in partnership with Breckenridge and our other managers in our shop, have done a really great job of owning, quote, all the right things. We only own mortgage-backed securities pools that are indexed as affordable to the borrower at the time of origination across a full 30-year ammo, because that's all that works for low-income families if you ask our nonprofit housing developers. We own SBA 7A loans, 504 loans. We own USDA RD loans. Anything that can approximate a borrower who otherwise couldn't get credit, we own all those things as a marker towards getting closer to our mission of poverty. The trouble is, I think we have optimized those missions to the hilt, and we own all the right paper in high credit quality communities, because that is the business. No offense, Tim's had this conversation with us. That is the business model of our managers. And so the next frontier for us is how do we come back down that credit curve, not just to be silly, because we're a fundamentals-based investor, but as an investor who builds communities. How do we invest in communities where we think risk is mispriced based on what we know about their spiraling up process? And so we'll be doing some of that in-house next year, so stay tuned. But
Can I answer that, though?
You can
Do you mind if
try.
we get in a conversation here? I think it's relevant. To a large degree, what's great about the U.S. muni market is the market itself has addressed some of that, right? So in New York State, for example, schools, and in most states, there's actually a state intercept program. So New York State schools all get, the communities are responsible for paying their own debt, but the state is there with an intercept, as they are in Massachusetts. And so it is at the general obligation level, where communities are borrowing money to build parks and libraries and things like that. You do tend to lean a little bit more towards more affluent communities. I think ESG, as we kind of go to next versions of that, will help normalize that a little bit. But the great thing about the U.S. muni market is it's already kind of addressed some of that, all under that lens of essentiality.
cool.
Can I ask the question I was asked while I suck at this? So my question is more about scale.
Yeah.
And I'm just kind of curious, since Heron's made such a mission of, kind of sharing this story with the philanthropy community, I'm kind of curious, do you ever think about so impact at Heron, I think, is very much at the portfolio level. And so I'm kind of curious, do you ever imagine how you would sit on the the board of a state university,
Mm-hmm.
where there's
And
kind
I
of a
do.
broader, where there's a broader set of stakeholders.
Yes.
Can you have these kind of conversations, and can you get them interested?
I jokingly say after all my time at Heron that our mission is helping people in communities to help themselves. Our super secret mission is to disturb other people's trustees. Yeah, right? So just suffice it to say that "Okay, Boomer" would have been an appropriate response to what came back at me. They go, as is the number one objection, they go to fiduciary duty. And I love to go there because what they point out is they point out duty of care and duty of loyalty. And for attorneys in the room, I apologize. Trustees love to hide behind fiduciary duty. Duty of care says read your board book, know what you're voting on. Sorry, attorneys. Duty of loyalty says it's not your job to get business for yourself in the boardroom. You're there as steward of the organization. Most organizations, if they have any charitable intent, also have a third leg, which is well documented in case law at the state level, that is duty of obedience to mission, where the court has actually negated investment decisions if the decision did not advance the mission of the organization. And in the specific case out in New York State, it says your raison d'etre is to advance the mission, not to make money with money. And so despite the fact that it's where trustees want to go, we need more. I hear you, Bruce. There's lots of bodies of work out there. We need more people getting to trustees and saying, not only do I think it's okay, I'm so tired of making it okay for trustees to do this. Not only do we think it's okay for you, we actually think you're in violation if you're not considering it. And the question that was over here in the first session about I can't do it if my beneficiaries won't immediately see the return. Well, I dare you to hold the rest of your portfolio to that standard. Yeah. Tell me that the rest of your conventional portfolio isn't causing more damage to your pensioners or to your beneficiaries or your stakeholders. And when you're done with that, we'll have the conversation about whether or not it's time for impact investing. You guys caught me on a really bad day. I'm just like...
Answer, but how easy do you find it, or how hard do you find it to identify enough investments that could fit within the profile that you're looking for?
Great question, and actually thank you for asking it. Because when people don't want to do this, they say, Heron's $300 million. They're the little engine that could. It's okay for them. And so here's the thing. That is definitely harder, no doubt. That said, that's the PRI portfolio. I'm still talking about the real money. It is not hard. No. It's hard. It's worth doing, and it is very available to any institution of any scale to say, are my investments doing more damage to my constituents than they are doing good? That is available in the market today. We just don't choose to do it because A, it's hard, and if investment shops are honest, they'll tell you they're not compensated for it. And the reality is I spent a decade, which is bizarre to me. I'm actually a farmer, both by birthright and by education. And then maybe if there's wine later, I'll tell you the story of how I ended up at Merrill Lynch for a decade. But coming through that experience, the reality is often there's not enough spread. Why would I do more in the spread I'm getting today if you're not going to compensate me for it? So back to our mission of disturbing other people's trustees, we tell them all the time, you pay your investment advisors and your managers handsomely. Make it part of their mandate that they opine to you what the impact, not your specific impact, but the impact of the operating enterprises that you invest in is. Last thing, and then I know we're probably way over time. So a current conundrum we have right now, remember, we're philanthropists and investor. Communities we work in, not our bailiwick, but they're all telling us they're ravaged by the opioid crisis, right? So we're not really in that business, but we're in the community building business. So when they say that, we try to respond. We're hearing it all over the place. Ravaged by opioids, ravaged by opioids. Okay, jump into our investment portfolio. What do we got over there? Keep in mind all those statements Bruce put up earlier, we support them. Yeah, they're good things to say. What they do will be interesting. But one of our constituent companies that you all would know is celebrating quite publicly the 70th or 75th anniversary of their purpose statement, that they are a purpose-driven company. They have been for almost a century. Hoorah. And they just got slapped with a massive fine because of their role in the opioid crisis. Okay, but as investor, we ask the question, how material is that trade line to their business? Less than 7%. What do you do then? The effect is ravaging communities. On a materiality basis, it's negligible. Where does materiality and values-based intersect? I don't know. We don't know. We struggle with it every day.
Doesn't that make it worse, the materiality?
To what?
Doesn't it make it worse, the
Oh,
materiality?
absolutely, because they hide behind it.
Marginal money.
Yes. By the way, Michael's one of my favorite colleagues, has been for 20 years. We beat each other up regularly. Yes, the immateriality makes it worse because they can hide behind it's tiny to us. But what of the scale in communities?
I would also argue that what you're doing is actually just really good investing.
Amen, sister.
So if you have, and my experience is in emerging markets for the most part, and it's part of the investment process.
Mm-hmm.
If you have a company that is evil in whatever way you want to define that, they're not paying their workers, all the cousins work in the company, they have poor governance, whatever it might be, it will come and bite you in the butt every single time. So if you don't do your homework as an investor, whether you're a portfolio manager or an endowment, you're going to get bit.
Yeah.
And this is not different investing. It really isn't.
Yeah.
As much as everyone wants to tell us that it's different, it's not different. And maybe in developed markets it's slightly different because there's so much more disclosure and everyone, celebrates their 70th anniversary as a good
Right.
company. But if you really get in the weeds with the companies, even developed country companies,
Yeah.
you will find things that you wish you'd known before you bought it.
Yeah.
Right? And it will always
Absolutely.
come back to you.
Absolutely. And that's why, by the way, I joke all the time with our staff that the way we evaluate public equities is like democracy. It's the worst possible thing, except for all the other versions we've looked at. That because to your point, I think when we started the portfolio examination process that I described earlier, I really think even as investors, there was some Pollyanna naivete on our part that we thought we could make 2 columns on our whiteboard and we could analyze a company and we could say good companies over here, we'll keep them, and bad companies over here, we'll divest them. And I think we want to believe that on some level, but when you start looking at data without a specific lens up front, it is, as you say, there are no pure companies. And sure, there probably are some that are evil, but we don't want to be in the name and shame game. We want to understand the data. And what we found, to your point, is that it's why we talk about net contribution, because some companies are fantastic on their environmental record, and they're horrible in their supply chains and to their labor. On net, so that's where values for us does enter. On net, how do we view that? Are we more okay with deleterious effects here than there? Because you're not going to find a pure company.
I think maybe we need to move on as well, but please ask the last question. And we will have an opportunity to ask you other questions after the sessions of the week.
Okay.
Great, this has been awesome. I feel like the conversation you're having right now around a great company with externalities kind of lends towards active ownership and the conversations you're having with those companies, and I'm curious if you can dive into that a little bit.
Sure. A quick answer is originally, because of our anonymity and our anonymous founding, we've never been an activist investor. We're many years since our founding, but that's still sort of our DNA. So we are not your proxy fighters. We rarely sign on to things. In fact, even now, if we invest in something or grant to something, we have pretty please don't use our name unless there's leverage. If there's leverage for you, okay, but otherwise, it's not our thing. We want to kind of lift up those who we support. But since we're also philanthropists, our view of engagement is that long-termism, right? Everything becomes material in the long term. So how do we stretch out the long-term view of CEOs? So we grant support mightily and sit on advisory boards for CECP, which, they just changed their acronym, now means something different, like Chief Executives for Corporate Purpose. It used to be Committee to Encourage Corporate Philanthropy, as founded by Paul Newman. So we support them, and with them, we all, it's group effort, we all have made it possible. Now 60, I think, CEOs have presented, mega cap company CEOs have presented their long-term plans in addition to their quarterly earnings calls. Fully Reg FD compliant, available on Bloomberg, building a platform. So that's our version of engagement, is how do we provide cover, clear path, et cetera, so that companies can speak to what we wish they were speaking to rather than sort of proxy fighting. And honestly, we're still trying to find our way. But it's that level of engagement. The company I referred to earlier with the opioid crisis, we got a hold of their CEO through those relationships, and we're like, congratulations on your purpose statement. How about destroying rural America with opioids? You know, and so you have those conversations. It's a very different looking version of engagement, and it's always evolving for us.
Thank you so much.
Okay. I think we're over time for this session, aren't we? Keep going? Yeah, there you go. Terrific. So I'm Christopher Rowe, and I work with the Church Pension Fund, which is the pension plan for the Episcopal Church. So we manage all of the retirement assets for the clergy and lay employees of the church. We were founded just over 100 years ago, with a small investment that was raised by a group of philanthropists, including J.P. Morgan. And they raised about $8 million at that time. And today the fund is worth $14 billion. So we have a robust portfolio management process where we allocate across different asset classes. So we have public equity, private equity, fixed income, real estate, and what we call specialty strategies, which is anything that doesn't really fit into any of those other categories. Rather than go through my prepared remarks, which are now falling on the floor, what I thought I'd do is sort of throw these aside for a couple of reasons. One, I had a bunch of ideas around sort of advice for young students, but I'm just calling it, I don't see a lot of young students in the room. So I'm going to throw that away, because you all know it. But I also want to respond to some of the questions that have already been raised. But briefly, just to tell you how we think about impact, how we analyze impact investments, we have a dedicated person actually who does nothing but look to source and monitor our impact managers. And she, unfortunately, was not able to be here today, so you have me. But what that does for us, and I think it's important, is a question was asked earlier, what is the asset class that is impact investments? Our impact investments are naturally integrated into each one of our other asset classes. So we have what we define as impact investments in real estate and in private equity and in fixed income. So we don't have a separate asset class for impact investments. In total, we have about $1 billion that we manage. We manage it in 3 general categories. That would be environmental investments, that would be economically targeted investments, and then finally, we have an initiative around minority and women-owned firms. Now, one of the questions is, we have $1 billion of the $14 billion in our portfolio. Why not invest all of it in impact, like the Heron Foundation? And I give them a lot of credit for doing that. And I start shooting arrows at me, but I'm going to say the word fiduciary duty, which is that, as a pension plan, we do have an obligation to our beneficiaries. And so with that, if we could come up with, and then we can have a good conversation about market rate, if we can find market rate impact investments for the entire $14 billion, we would do it tomorrow. And so that's just saying we have an appetite for that, but we also really go through a very rigorous process for every investment we make, including impact investments. There was an earlier point, I don't know who made it, around sort of a bias. I think you made it, a bias against impact investments, and do we hold impact investments to a higher standard? I think that definitely exists, and we work to fight that. So for example, one policy I will say that we have is we generally don't invest in first-time funds, that there needs to be a track record, right? But one of the issues with a number of the funds that come to market is a lot of them are first-time funds. And so how do you get over that? And one thing I'm very attentive to as part of the investment meetings is if someone outside the impact space brings a first-time fund to our consideration, I'm going to call it and say, you objected to it over here because it was a first-time fund in the impact space. You can't propose it over here because it's not. We have to have sort of the same level playing fields. So turning that around, the other point that I would say is every one of our investments, including our impact investments, are subject to the same standards. So if we hold ourselves to the same standards for impact or non-impact, then we're doing our job as fiduciaries. Just one example, though, in terms of where are we willing to compromise? Where are we willing to do something different? So while we maintain the same standards for all investments, for the impact investments, one area that we will go further in is around doing the additional work to actually get the deal done. And we will also be willing to do smaller investments than we normally would otherwise. And so our investments with SEMA are just one of those examples. So early on, Alan Snoddy, and Assad can attest to this, Alan Snoddy, who is our head of real estate and a key supporter of impact investing, really worked with Assad on structuring the SEMA investment portfolio in terms of looking at the different tranches for risk and return. And where we came in as a firm wanting to be catalytic is we were willing to take basically any layers of the capital stack just to get the fund off the ground. Then when other investors came in, we had flexibility to say we'll move up and down the capital stack, but we were ultimately willing to put our name and our money behind what Assad was doing in terms of his vision for SEMA. One other piece that I think is critically important to understanding who we are as a firm is, of course, who we serve is the clergy of the Episcopal Church. So we're constantly being asked, what are you doing with our funds? And so we say publicly that we look to support church values in all that we do, and we do. The first value that we look to support is the value of keeping promises. We're going to make your pension payments. And it's critically important, so unlike a corporate pension plan where if you don't make that return, you can go back to corporate earnings. We are not going back to the congregations and telling them to pass the plate again. So sort of our focus on return, while we might be criticized for it, is really fundamental to keeping promises. But beyond that, then, we think about areas that are of concern to the church, and we look to support those areas of concern to the church. So any of you see Harry and Meghan's wedding? The royal wedding? Yes. Good. So you might have seen Bishop Curry, who he sort of caused a stir with his very passionate sermon at the wedding. And he has areas of focus that he wants us to focus on, and two of them are care for creation, stewardship of creation, and racial reconciliation. So, I mean, we take our clues from Bishop Curry and others in the church to see areas where we should focus. And so for care for creation, investments in renewable energy are a natural. For racial reconciliation, investments in affordable housing and underserved areas is a good way to put our capital to work. And we can find market rate returns in those spaces. And so another question came up around what is market rate, right? Well, there is not a single market, you're right. But we do have a good sense for risk-adjusted return. What should you get in PE? What should you get in fixed income? What does a certain credit provide you, right? And so you sort of know it when you see it, but you have a sense for what is an appropriate risk-adjusted return for this asset. I will also say and acknowledge, someone mentioned investments in Africa, investments in other parts of the emerging markets, investments in Pakistan, where there's biases against these regions of the world which may present opportunities. I think that's absolutely true. I think there's a natural inclination to and it almost comes down to racism, but there's the emerging markets in Europe somehow are more acceptable than the emerging markets in Africa. So in terms of sort of level setting our expectations, we need to sort of remove a lot of that bias in the impact investments that we make. final point, and then we can have some questions. One of the areas that we've been thinking about impact investing is around climate change. And so I know you mentioned climate change as an important issue. So we've borrowed from one of our asset managers the concept of a prepared mind. What is a prepared mind? So we think about, we get all these different ideas from asset managers building up from the bottom up. But what should we be thinking about from the top down in terms of thematic investments that really will pay out over the 5 to 10 years? What are the big macro trends that ultimately will impact markets, economies, and portfolios? So one of those themes that we've been looking at has been climate change. Of course, we all saw the National Climate Assessment, which just rang the bell that a disaster is at our footsteps, right? And it was really shocking. But anybody who's following it has been seeing this coming. The next step, though, is what should we do about it? And the San Francisco Fed came out with a very interesting paper where they talked about climate change in relation to their responsibility as the Fed. And of course, the Fed is responsible for making sure that we maintain full employment, monitoring inflation. They say their role is not to solve climate change. But what they did say was, as the Fed, if we're not looking at the economic impacts of climate change, we're not doing our job. I would say, as a pension fiduciary, if we're not looking at the environmental, social, governance issues, if we're not looking at the economic impacts of climate change, we're not doing our job. And so we started to think about putting a climate change lens on the portfolio. So with all the doom and gloom that is around climate change and what it will ultimately do to us in the next 5 to 10 years, I want us to think about optimism and opportunity. So I believe that investors are innovators. Investors are problem solvers. And they will come up with a solution to the issues that we're facing. We certainly can't, at the moment, rely on our government to do that. So I would appeal to all of you to give us your best ideas around those solutions.
Thank you. So you talked about your fiduciary duty, and you link that closely to market returns.
Yeah.
And I wonder, because Bruce also talked about mainstreaming, and it seems that there's no level playing field here. We look at returns as, you invest $100,
Yeah.
and you get 105 back. So you make 5 as a return.
Sure.
But if we look at indeed the effect that you can have with your money in emerging markets, etc., it seems that there's so much more value to create with your money, and if you don't count that somehow either in your expected return, in your return, financial return, or in your risk, it will always be the case that you're going to have difficulties comparing the two. And I wonder if you're looking at such, because in the end you're beneficiaries, if you can tell them, like, okay, this is the financial return that you get, but we also somehow were able to quantify the social return on this investment.
Right.
And then together, at the same risk you can get this, then you actually are adhering to your fiduciary duty.
Yeah.
Is that something that you're also looking at, and how can you quantifying it and then eventually come to a metric that actually works when you have that discussion with them?
So underlying your question is the whole question of externalities, positive and negative, in the investments that we make. And there's certainly the case that every investment has impact. Every investment has some kind of secondary or tertiary effect. So I would answer your question in 2 ways. One is, again, we believe environmental, social, and governance issues can be material issues. And the managers that we hire, we expect that they incorporate those into their investment analysis. So if there are underlying risks associated with a particular investment from a governance standpoint, from a social standpoint, from an environmental standpoint, we expect that to be quantified and calculated in their investment rationale. We're holding them accountable to that. And I agree with you philosophically that there is incremental social return, but we can't write a check on a social return. And honestly, so the mission of our organization is that priests do not retire in poverty. And it goes back 100 years ago, right? That 100 years ago, priests, because they were motivated by mission, motivated by doing good, motivated by making a difference, which of course has a value to it, but at the end of the day, at the end of their career, they don't have money to feed their family. That is not happening. So our mission is to make sure that we make that payment. And you can, and so unfortunately, we have to quantify our value in the actual specific return in the portfolio and not the incremental social value. In the back over here? Yeah.
Given the commitments that you articulated to church values and also to integrating ESG as very material considerations across investment and asset classes, are there industries that you just won't consider investing in, whether they're weapons, guns, carbon, private prisons,
Right.
tobacco, et cetera, that you'd rather just avoid?
That's a great question. And so as a general rule, we don't have a divestment policy, which is, of course, challenging. And so the whole question around divestment is really difficult. So all the issues that you mentioned just there, private prisons, guns, fossil fuels, you keep going down the list. So there was Milton Friedman was in one of Bruce's slides talking about the purpose of the corporation. The University of Chicago and a lot of academics will talk about if you have a universe of stocks and you start to peel it back, you automatically reduce your opportunity set and you automatically are lowering your expected rate of return. So there's, from an investor perspective, there really is an investment rationale for why we wouldn't want to peel back half of our universe, or there's always the slippery slope. If you divest from 5 companies, then why not divest from 10 companies, and then it keeps going. So rather than allow that slippery slope, we focus on engagement. So one thing I didn't talk about is we do have a shareholder engagement strategy where we prefer to actively engage with companies on issues. Now, fortunately, at the moment, we don't hold any guns and we don't hold any private prisons. But on the engagement side, what we would look to do is sort of engage around the ancillary elements of those issues. So, for example, what kinds of companies are providing services to private prisons and taking advantage of inmates? What kind of companies are providing financing to the gun industry? And how is that working? And are banks doing a good job of responsible lending? Those are the questions we're starting to ask on those issues. But we look for avenues of engagement wherever we can have it.
Thanks for the great presentation. I'm curious to hear a bit more about the new products, first-time funds, and maybe two quick questions. One, do you have any ideas for how to solve the puzzle that you articulated, which is people don't want to invest in first-time funds? So do you have any ideas for that? And then I guess part B is any new products that you would love to see come to market?
Yeah. So in terms of the way to solve the problem, a solution, and I would again point to Assad and Seema on this one. In effect, Assad's fund was a first-time fund, but Assad came to that fund with enormous credibility from his previous experience. So we knew him from his previous work. We knew what he did. We had confidence in him and his team. So I don't know. I know it's not a great answer, but if there's a way to demonstrate other areas of credibility that would give us confidence that your first-time fund is repeatable based on what you did in the past, we're willing to take the leap of faith, and we certainly did that with Assad. In terms of new products and new ideas, as I mentioned at my closing remarks, we're very interested in solutions around climate change and what can be done in terms of remediation, in terms of adaptation, and in terms of resilience. Anything that can sort of speak to that theme, I'm very interested in seeing.
You had mentioned certain sectors for impact that you've been able to find market rate returns. Climate change, renewable energy has been one that's come up a few times today. You also said affordable housing,
Yep.
and would be curious to learn a little bit more about that and how the type of investments are able to achieve your return objectives, and then other sectors where you've had trouble finding the returns you're looking for.
Great question. So an example of an affordable housing investment we have made, is with a company called Avaneth. I don't know if anybody knows Avaneth, but they provide affordable housing primarily in Southern California. And one of the things that is really remarkable about the investments that we've made with them and the housing that's there, when one thinks of affordable housing, you sort of have a dreary, dark, sort of less than quality sort of opinion about it. If you see photographs of the affordable housing that Avaneth has created, it looks like a standard middle-class community. It's very clean properties, swimming pools, basketball courts. Also key here is they provide additional services such as after-school care, which if you think about sort of people at the margin, providing that entire ecosystem of a community where your kids can feel safe, your kids can be cared for after school, you can go to work, it really has incremental impact on the overall community. From an investment perspective, and this is interesting, and I would echo this in terms of some of the economics around SEMA, there's always a question around how do you make money off of poor people, right? Are we taking advantage of poor people? But the fact is, these affordable housing investments are below market in terms of price, and there's a line out the door to get into these affordable housing units. And so from an investor perspective, the cash flows are consistent, they're reliable, and the properties are well maintained. So on an investment opportunity and risk perspective, great. On an impact investment side, fantastic.
I'm just kind of curious from trying to find a parallel between you and Heron in terms of the board.
Yeah.
And kind of the evolution of this discussion. Has this been a polarizing conversation at the board level? Has it been evolving over time? Does your board look different than it did 10 years ago?
It's a great question. So years ago, there was just a socially responsible investing subcommittee of the board, and it was an ancillary part of the full board's discussion. We have a large board. We have a 25-person board. And I would say some of the more challenging conversations, back to the earlier conversation around divestment, is how do we think about the issue of divestment? Do we divest? Because every company has good parts and bad parts, and so where do you draw the line, and how do we have that conversation that you're, right, like private prisons is a perfect example. We don't own any private prisons, we haven't prohibited it, and so that's a sensitive topic. But in terms of the evolution, we've gone from a side committee of the board to where we have 4 presentations a year to the investment committee of the board on what we're doing in terms of socially responsible investing, and then 1 presentation a year to the full board. So they're engaged, they're very interested in what we're doing and why we're doing it.